Good morning. You're watching The Market right here in 80 now with me, Asha Faridi, Avan Dabash, Nikunj Dalmia in the studios. And the same story really continues for the market. While yesterday you did see that perk up to that 20,100 level, we couldn't quite sustain to the day's highs. And we cooled off clearly from there. So just about managing to hold our head above water. And we did manage to finish off at that 20,100 mark, just about post-adjustment. Having said that, it's really metals which have come to the fore. They're the ones which are seeing buying. IT banks, some of them or large part of them did take that bit of a backseat yesterday. So the benchmarks, Nikunj, they continue a very narrow band. You don't know, or rather you're in anticipation and anxiety about what's going to happen post this consolidation.
No, Aisha, I think you can look at, we can look at Tuesday's price action in isolation and say, okay, big day. Correction happened. We can look at yesterday's price action in isolation and say nothing happened. But what is the trend? The trend is that the markets are falling less and they're gaining more. Yeah. That's Nifty for you, right? Similarly, if you look at small and mid-cap stocks, look at the last 4-day change. My producer will just fire it, 1 week change, small cap index, mid-cap index. This is yesterday's change. And let's look at the 7-day change. Where is the correction, my dear? I mean, for a market which everyone has been thumping the table and they've been calling out for a bubble, mania, a craze. The market is, the mid and the small cap stocks saw 1-day blip, a deep dive, and they have recovered very smartly. From Tuesday's low, if you add back the comeback in the small cap indices and the mid cap indices, even the railway stocks and the defense stocks, they managed to bounce back. So for the sake of turning bearish, there is no point in turning bearish. We must respect the market momentum. The market is telling you that, look, the bulls do not want to relent. Markets will not go up like this forever, but maybe right now they want to go higher. So if you're watching the screen for the sake of turning bearish, don't turn bearish. There is no point in trying to go against the mob. The mob is literally going to rob you. The best strategy in this market is that now you got to ask yourself very frankly that what is your risk appetite, and you have to be prepared for a 15 to 20% swing at any point in time. If you cannot take that 15-20% swing, maybe mid and the small cap stocks are not meant for you. But if you can digest it, then you might as well be inside the ring. Yeah. The only way you should be out of the ring is that you can't face the heat. If you can't face the heat, then you might as well be inside the ring.
Be inside the ring and enjoy the ride, I guess.
No, I'm talking about arena here, no ride. It's like a gladiator ring.
Okay, but perhaps if not as harsh as Gladiator. I just had a vision of all those
By
fights.
the way, new Gladiator is coming. I just saw on YouTube. Yeah.
Oh my God. It's one of my all-time favorite movies.
Yeah, I've seen that movie, I don't know.
Yeah.
Movies now had it.
Okay, it's going to be anything but a Gladiator type of morning, perhaps going by what the rest of the globe is suggesting, because it was a nice welcome move on the upside, a nice winning session that you saw on Wall Street. There you have it across the board. Smart gains being witnessed, and that's largely in particular on the back of the extended technology IPO drought that we've seen. And then there was a fresh batch of economic data as well. I'm talking about ARM. That company saw nearly 25% on its debut just yesterday. It opened above $51 per share in the IPO price, only to close at close to $64. So clearly that was a smart mover in trade yesterday. You've got the Asian screen as well, which is piggybacking on that pretty strong momentum. So across the board, you've got the Asian markets, which are holding out in the green, and you've got some key economic data that will be coming out of China. So at least going by that, you've got a pretty strong handover. The dollar index at a 6-month high, Brent quoting at close to $94 a barrel, and the ECB signaling that it could be the end of the rate hike cycle, Nikunj. So we're looking at pretty strong global cues for us this morning, so that perhaps that'll tide us higher.
See, we are in that phase of the market where when global cues are bad, we are falling less, and when global cues are good, we are capitalizing on them. Yeah. So it is just one of those setups in the market where we are not reacting to bad news and we are capitalizing on good news. And that is the undertone of the market. Folks, please remember, it's very easy for anybody to come out and say, okay, markets have peaked out. It's very easy for anybody to look at historical data points and say that, okay, markets are trading expensive. But there is no rule book which says that expensive cannot become more expensive and overbought conditions cannot become extremely overbought conditions. So don't be a hurry to say that, okay, this is the red line beyond which I will not go. Global corrections historically, or corrections in India historically, have only happened when there has been a global crisis. 2001, 2008, 2012 and 13, 2020 and 2022. Yeah, that's the time when the war happened. So these are the factors when large reversals in the world has happened, and India in a sense has just cracked because of that. So for sake of turning bearish, there is no point in turning bearish. Anurag Singh joined just now. Let's take our conversation forward. Anurag, I've got at least 2 research reports every day on my table which says that markets are richly priced, trading above the historical averages. It's time to get out. And for those who are doing it, and those who are looking at historical number and trying to understand the future, they're only regretting now.
No. So Nikunj, morning first of all, and no, I agree. Look, I heard your views, and I agree that at no point market is the best judge. We should not jump in between and say that it's richly valued. But the fact remains that at least experience in the market teaches us that when something is richly valued, we know it's richly valued, right? Now, only 2 things can beat it, which is either the earnings grow in an unprecedented manner, which beats our expectation of the earnings. And so the richly valued becomes actually reasonably valued. That's one point. Or otherwise, there is a global, growth happening across the world. Now, second scenario is unlikely because growth is shrinking across the globe. Easy money supply is kind of coming to an end. It has already. And I think that the whole capitulation of US market has not really turned out that bad, actually. So on the face of it, it's looking resilient. But I understand it. Indian market has a very different story of liquidity and money supply. But out here in US, I think we hit at a point where markets really begin to wonder, actually, are we running ahead of fundamentals? Let's not also forget, Nikunj, out here, it's a magnificent 7 rally only. So just 7 stocks have contributed 75% of the S&P growth this year. So that's not now, what do I do with the other 493? That's the conundrum that I am into out here, Nikunj.
So what should one do? Look at historical data, look at the narrow part of the market, and then perhaps preempt a fall and raise cash, or enjoy the party as long as it lasts. Get out only when the music stops, and the music could continue. It could really continue well past the Cinderella time also.
Yeah. No. So that's the whole story. So again, if you have the luxury of moving out, our fund has a luxury of moving out. So I, of course, I'm more than happy to stay 50% cash. And that's the kind of, I've been waiting for the last more than a year now, almost since 2022, to get a right point to deploy the rest 50% in. And meanwhile, that's enjoying a 5% yield on the two-year bonds. But at the same time, I think it depends on the kind of investor you are in, right? Because most of the people listening to us right now, coming from India, if they are a SIP investor, they should invest. They should continue on those SIPs, although more on the large cap side, less on the small cap side. But aside of that, I think, Nikunj, I have been a strong believer that if you overprice too much today and you price in too much of future, you borrow something from the future coming years, right? So market should grow, but they should follow the earnings and the growth in the economy. And somewhere, if you run too much ahead, I think you need to come back again. So it's. I think that's the conundrum we should not forget. Ultimately, even out here, the S&P earnings. Take these magnificent 7 stocks. Apple earnings for the last 4 quarters are dropping, but the stock is back at 30x. Now, what is this? What is this promise? I'm happy to sit on the wayside in a dropping earnings scenario. That's the case with Google. That's the case with Meta. You name it. And I don't know whether this AI hype, it's kind of preemptive to think about all those things. My sense is, Nikunj, ultimately we need a bit of a jolt, at least in the US market. we've not really cleaned up the excesses of the pandemic. Government is still running a 6% deficit. I mean, can you believe it? I mean, it's like the hottest economy we have, and there is still a 6% deficit that the government is running.
All right, thanks so much for joining in, and Anurag giving us your take on the overall market sentiment. Let's move right on then, and we've got lots of global commentary as well coming in. Let's take it across to Harsh, who joins in with a quick snapshot. Morning, Harsh.
Well, good morning, Avan. You're looking first off at Mohammad Al Arian. Well, he's speaking about how stagflationary pressure is blowing through, especially the global economic and the global context of it. What he's suggesting is, especially with regard to where the West is concerned, US, Europe, they've been hit by this stagflationary pressure, largely also now getting pushed up higher by even higher oil prices, and that he expects that that pressure will continue. Quickly moving on, he's also given a quote with regard to what the ECB has done. Raising 25 basis points is what the ECB has done to policy rates yesterday, and he said that this was largely a coin toss. The 25 basis rate hike is not really surprising because ECB has the single mandate of really just lowering inflation at the moment. The central bank, and despite this weak and weakening economy, is still continuing to focus on increasing rates, lowering inflation. That's what he continues to suggest. But what he also seems to suggest is it's a very interesting inflection point at the moment to try and see what President Lagarde now does with regard to policy going forward. We'll quickly move on to Peter Schiff as well. Peter Schiff talks about how August US producer prices really spiked around 0.5% plus spike, higher than expected, and he believes that this jump is the highest since June. Of course, oil has played a big part in this jump, and he believes that oil is already up another 6.5% in September. 2% inflation target likely will not be met in Powell's term. That is very strong statement released by Peter Schiff there. He also talks about how oil is really shaping up. Today, oil is at $90 a barrel. He says 40% over the past 4 months is the growth in oil prices, and that hardly seems like as if there is any disinflation really happening going forward. He also expects that unless reserves of the US are used up, oil will continue to rise and will rise to $150 a barrel is what he predicts by election day. So really strong words coming in from Peter Schiff on oil as well as inflation.
All right, thanks very much, Harsh, for giving us that roundup. Let's connect with our charters then. Naresh Merani and Kunal Bothra joining in as always. And Kunal, I saw you doing some counting. What data were you decoding?
No, I think the data is staggering because it's a 31% drop in open interest for Bank Nifty.
Okay.
So we started the September series at 23 lakhs 64,000 odd open interest for the Bank Nifty. We are at 16 lakh contracts, which means there is a reduction of 7.5 lakh contracts, 7.5 lakhs on the open interest for the Bank Nifty. That's huge, and I think from that 44,300 levels where we started off this high or heavy built up in terms of open interest, we're now at 46,000 levels plus.
Indicative of?
That's indicative of a massive short covering. So there are two parts to it. Bank Nifty is going through a major short covering, a 30% drop in the open interest. Nifty on the other hand is going through a long built up formation because in the last I think 8-10 days we've seen more than a 15 to 18% jump in the open interest for Nifty. So two different indices, two different kind of trends for the index. One is rising on the basis of long built up, and the other, the pace has rallied because of the intense short covering which has happened.
Okay. Naresh, hi, morning. What's your sense? Some consolidation yesterday. Where are we headed next?
So the trend is clearly set after breaking out in new all-time highs. The ideal target price is for 20,500 on the Nifty. Same way, the Bank Nifty should ideally cross the previous highs of 46,300 and may even attempt 47,000. And now, as we keep moving forward, the base will shift higher. So as of now, the base is at 19,800. We shift towards 20,300. The base, say, support will start shifting towards 20,000. So overall, the momentum is strong. The last 2 days of recovery is also good in the broader markets as well. We've seen a better recovery yesterday in the mid-cap and the small-cap indices. So the bias remains positive. Though only concern is on the small cap and mid cap, we could take some time to cross the recent highs. But on the Nifty and the Bank Nifty, we wait for the momentum to continue and Bank Nifty to make a new all-time high.
All right, let's find out what individual stocks as well our chartists are picking out for the day. And Kunal, you do have a bit of a tilt towards the bank.
Yes, definite tilt towards the bank, and even from the metal/commodity names, NMDC is something which I would flag off. Excellent chart for the stock yesterday, closed at the high point of the day at 149.50 odd mark. Good strength in terms of the volumes which was seen for NMDC, and that too even on every intraday block for the stock, where the stock moved up higher, it was in the back of some heavy volumes, and even on mild consolidations the volumes dropped down. So that's an indicative of long built up for NMDC. Would suggest a buy with 159 as a target, stop loss at 143. And second would be a buy on Union Bank. So again, tilting towards the PSU banking stocks, which I've been doing over the last 2-3 trading sessions. Union Bank is the other name which I would suggest as a buy. Classical chart heading towards a breakout of 94.95 mark, 105 as a target, stop loss at 89.
All right, let's find out what Naresh is picking out for the day. And Naresh, which are the two stocks that you're betting on?
So both are stocks which have consolidated or rather drifted lower and consolidated and now making a comeback. So first is a buy on UPL. The stock corrected, broke below various levels at 700, 650. Started to make a base around the 600 plus minus 20 points. And yesterday was the first price and volume reversal, indicative of a short-term bottom being in place and heading up towards 680 in the short term, stop loss at 620. Second is a buy on Granules India, which has also consolidated well. The last 3 to 6 month high of 325 to 330 zone has been crossed. Good volumes yesterday, and has been a relative underperformer in the whole pharma pack. Seems like a trend change out here. Could go at least towards 370 to 400 mark in the short term, stop loss at 324.
Okay, let's talk about some of the other stocks as well. Anisha is here to flag off some of them. And Anisha, one wonders where to buy in this market. And clearly, IT is top amongst our list, and so is for Spark. They're picking out TCS.
Oh, well, yes. And the big question that actually we were discussing out in the newsroom was the fact whether the cycle of upgrades has now started, because I was just looking at the breakup in terms of for TCS, for instance, there are 13 brokerages which are still a hold on that stock versus 3-4 which might be a sell. And then, of course, buy stands at 20. But then there is that room for those 13 to probably upgrade. And that's the thing that has started perhaps with Spark. They have upgraded the stock to an add. Now, they are saying that, of course, the transition that we have seen in terms of leadership could be quite positive, and Kriti is something that they Kriti has been somebody that they have been talking about quite positively, because Kriti was, of course, focusing on the BFSI vertical, which forms almost 35-40% of the business. So going forward, that is expected to pick up with him coming in at the forefront. Secondly, if you look at the new organization structure as well, which the company has adopted, this is pretty much in lines of what they had earlier and had worked well for them for a long period of time. So this goes back to the normalcy in terms of what has worked well, and they are trying to adopt that itself. The other part is, of course, the company's strong execution, which is evident in its industry-leading margins as well, and that's likely to be a valuable asset amidst the rising competition, is the point that Spark is trying to make. They have been taking proactive steps to reskill the new talent as well for generative AI, etc., and return ratios too are better than rest of the peers. So TCS, of course, is one stock on account of that will be watching out for, but the IT sector as a whole has been doing quite okay. Of course, Infosys also reported to the exchanges that they've signed a memorandum of understanding with one of the global clients, and the potential is $1.5 billion over the next 15 years. So yes, it's a long gestation project coming in, but nonetheless, the good news is at least continuing. There's no incremental bad news for the IT sector.
Anisha, what Spark is not also mentioning is the P multiple of TCS. Please have a look at the P multiple of TCS. It is almost at a 30% premium to, let's say, almost at a 50% premium, if I'm not wrong, to Tech Mahindra, and almost a 30% premium, let's say, to HCL Tech, and a 25% premium at least to Infosys. So TCS in this year actually has not corrected at all. You look at Infosys this year, you look at Tech Mahindra, and you even throw in, let's say, Wipro. You will actually see a big stark difference in the performance of some of the tech stocks. And even in terms of the valuation picture, there you go. Look at where TCS is. Where is TCS? It is at a premium. So nobody is questioning that things are getting better for the IT space. For IT space, there were two factors at the beginning of the year. Bread and butter business was looking slightly puffy-duffy, and the generative AI disruptive impact. We don't know what the AI impact would be, but the bread and the butter business is making a comeback, and the stocks have also made a comeback. Large deals is something which markets know. So I think it will be too early for anyone to assume that the upgrade cycle will start. Even if the upgrade cycle starts, Anisha, at the peak of the cycle, which is when everything was looking hunky-dory for TCS, the P multiples were just north of 30. So at the peak of the earnings cycle in 2021, the P multiples were 25, 30, 31 times. Now they are almost there again. So the headroom for the earnings upgrade cycle to fundamentally justify a reversal in terms of business and stock, I think is difficult.
But do you think they are as overowned as they were earlier, pre the cuts that we had seen?
No, they are not, Anisha, but these are stocks which are classic institutional stocks. These folks, they own them. They like them. I mean, for a lot of our audience here, I would say the space or the pot of the gold now is in mid-cap IT, specialized IT companies, or perhaps some of the SaaS companies. I'm only talking about the relative rate of return. I mean, IT stocks, the large cap IT stocks, let me put it this way, they will keep you rich, they will not make you rich. Very simple.
And richer will continue getting richer.
No, you'll manage
Always
to
the
beat inflation.
case.
You'll manage to beat inflation.
Okay, if that's good enough for you, managing to beat inflation, then perhaps large cap IT is the space. But if you're looking at multi-baggers and beating the index, perhaps mid-cap is the space to be. But the big question is, where will banking stocks land up in this kind of metrics? Because HDFC Bank has been underperforming. The big overhang in terms of merger is behind us. And today, of course, the stock is going to be in focus on account of the FTSE and MSCI readjustment that will happen. It's FTSE as well as Sensex readjustment that will happen. And the expectation is there will be an inflow of almost $600 to $650 million. Usually, this happens in the last half an hour, 1 hour of trade, so we'll watch out for that. But remember, this is going to happen in 2 to 3 tranches. That entire $1.5 billion flow that was expected, it will be 600 million plus 600 million plus the rest. So there is that visibility in terms of staggered buying coming in. Of course, there are other stocks which will be in focus on account of that as well. But overall, Nikunj, I'm just confused about how one should look at the banking space. Earlier, there was a bit of an edge for PSU banks versus private banks. Right now, not really sure whether there's still that edge or not in terms of buying interest.
See, the banking is the new defensive, and I would stick my neck out and say that. What is defensive? Well, something which will fall less, a sector where you are comfortable with the earnings or valuations, and you can predict next 2 or 3 quarters or at least 4 or 5 quarters of visibility. Can you predict that in case of banks and large cap banks? The answer to that is yes, sir. Within HDFC Bank, well, I mean, the best contrarian buy according to Samir Arora is actually HDFC Bank, and the best visibility in terms of a Nifty 50 company for next 3 or 4 quarters, with the exception of, let's say, an L&T or some of the capital goods stocks, I think is HDFC Bank. So this is one of those stocks where if you're trying to time, FTSE flows, MSCI flows, yes, 2% here, 1% here, may happen, may not happen. But can this be a core stock for next couple of years? I think there is merit in considering that. That's my simple point.
Okay, fair enough. That's Nikunj's take. Anisha, thanks so much for giving us that roundup on TCS, and we also discussed the major rebalancing and HDFC Bank. But let's move right on then and put the spotlight on the auto space, because Tata Motors has unveiled the Nexon EV facelift. It's priced between 14.7 lakhs to 20 lakh rupees, and it's been inspired by the Tata Curve concept. It shares design elements with the ICE-powered Nexon facelift, which is launched at about 8.10 lakh rupees. Sumit Chaturvedi caught up with Shailesh Chandra, the Managing Director for Passenger Vehicles and EVs. Let's listen in.
Nexon, when we had launched Nexon EV in 2020, the perception of electric vehicles were very poor. It was seen as, cheap, low cost, the low range, city, small, tiny car, but very high on cost. So it was not practical. And it was Nexon EV which really changed the perception of EVs and defined what should be the standard of EV cars in India. And that is what took the volumes of EVs as an industry, I'm saying, from a pre-Nexon EV era of 150 per month to today about 8,500 units per month. So therefore, Nexon EV has a stature, it has a responsibility and a role to play as far as electrification in the country is concerned. So it should always define and be the benchmark of what an EV should be in India.
And about the Nexon, the real Nexon which you launched, it's also been given a full, we can say that facelift, and it's a new avatar now. What changes in the Nexon apart from EV? The new other Nexon, what changes there also?
See, that Nexon was, ICE version was the first Nexon in its true life, launched in 2017. And it was known for few things, which has made it successful and number one SUV in the country. What are those? One, that the design was very, very unique. And it defined the safety standard of the country. It became the benchmark of safety. And also, it always gave performance and technology which was a notch higher. So when we conceived the new Nexon in its ICE avatar, new avatar, we said that this should go to the next level. It should go way ahead of what one expects in this segment. So there also, you are going to see that the design has become more futuristic, more techy. The tech has gone to a different level of what you expect in a gadget actually. And then safety, a lot of feature enhancement have been done to now set the new benchmark for safety. And you get with new options like DCT, which makes it more smoother and convenient to drive and make the experience even more smoother. So those are the kind of changes that the new Nexon in its ICE version has got.
Back with the market right here on 80 now. Let's just revisit what the GIFT Nifty is indicating, and some more upside for us. 20,200 plus levels is what it's hinting at. But India is one of the fastest growing beauty markets in the world, and Nykaa is one of the major companies in that market. We spoke exclusively with the CEO of Nykaa's beauty e-commerce department. Let's hear out his opinion.
Growth of the beauty market in India is much faster than that of other markets. But yes, the per capita consumption is still relatively low compared to other markets. But that's obviously because India is a very large country with over 1.3 billion people. So what we are expecting is a growth in the per capita consumption, and India should be the fastest growing beauty market for many years to come.
There is beauty and personal care, there's cosmetics, but in terms of apparel also you have presence online. Is that a possibility in the future?
So on the fashion side, Nykaa Fashion, it has a couple of stores already, which they're piloting. And we have some of our own brands, like an athleisure brand called Naked, NYKD. And they've also launched in physical retail. So I think it depends case by case. And, we'll be testing, understanding the market better, understanding the consumer. If there's a need for it, it's a possibility. But as of today, publicly, we're just speaking mostly about our beauty store expansion at this point. Right now, we are very focused on growing our e-commerce business for Nykaa Fashion. It's hardly a 3-year-old business, and it is already one of the largest fashion portals online already. The beauty business is 10 years old, so it's a little bit more mature. So the beauty business is in a good place to continue to expand offline. Fashion is focused on improving and excelling online. And yeah, from time to time, we will think about if it makes sense to expand offline. That is a possibility, yes.
This fashion store coming, yes, fashion store coming to metro cities, when will that happen? I mean, are you targeting this pilot across certain cities right now?
No, as I said, we already have a couple of fashion stores that are up and running in Delhi.
But the next...
and in Bangalore as well. No, as of today, we're not speaking publicly about our expansion on the retail side for fashion. As I said, that's something we're looking at internally. And of course, as in when it's ready to go, we'll let you know.
All right, that's a word coming in from the management of Nykaa. But moving right on then, let's talk markets. And there's clearly room for a correction in midcaps. That's the word from Chris Wood in his latest Greed and Fear note. He adds that India is the long-term structural growth story in Asia and not China. Let's get in the key takeaways from this note. We've got Anisha standing by to walk us through that. Anisha?
Well, yes, Chris Wood was in India on account of that G20 event as well, and No wonder then that he's quite confident about the momentum he's seeing on the ground. As far as the mid-caps is concerned, yes, he talks about the solid rally that we have seen in the mid-cap index this year and calling for some room for correction as well given the valuations. But he says that valuation in big cap stocks are not as extended because the foreign investors are not as overweight India as one would assume it to be. They talk about the flows and the kind of exposure that a lot of these foreign institutions have to India, and it has still not reached a very high level. So there's that room that there'll be more flows coming into India. And of course, the first port of call is going to be the big cap stocks, and that's why they're talking about that. The consensus across the globe, as per him in his conversations with clients across different regions, seems to be that India is a long-term structural story and it's not China anymore. So the increased interest towards India is something that we are watching out for. Of course, he talks about the real rally that has been there in the mid-cap edition, but the continuing rise in oil price is something that he's flagging off as a risk. So one needs to watch out for that, because if the oil prices continue to rise, we might see a bit of dip because inflationary pressures will start, again pressurizing our markets. Back to you guys.
Right, and Anisha, tell us all about RPSG Group's Investor Day as well.
Oh, well, yes. So RPSG Group held its Investor Day. Usually we don't talk about this group, or at least they're a bit media shy and analyst shy. We don't hear too much commentary coming out of them. That's why it's very interesting to track that. The Investor Day, of course, was on 12th September. So it's been a couple of days, but JM Financials has finally written a note on the same. The big headline as per them is the fact that the group is looking at doubling their revenues and making the profits 2.5x over the next 4 years. Of course, there'll be tuck-in acquisitions that they're going to do. There's operating leverage that is going to play out. Plus, they're looking at increasing the share of the high-margin business. So that's something which is expected to augur well. And the entire group is quite focused on increasing the shareholder value. Let me get company-specific now, and let's start with First Source. There, they reiterated the guidance of 2 to 5% growth with a margin profile of around 11 to 12%. The growth strategy for them is about client mining and cross-selling. So that is what they're focusing on. There's margin lever in terms of increasing the offshoring as well. And the mortgage market, which is a large part of their business, has stabilized now. So whatever the dip that we were seeing in the business has now gotten arrested. Quickly moving on to CESC, the power unit of theirs. There's an ongoing turnaround there at the Rajasthan distribution. They're focusing on Chandigarh distribution and expansion as well. The renewable capacity is expected to be added by 3 gigawatt over the next 4 to 5 years, and cost reduction is also an important factor for them. For PCBL, which is the Philip Carbon Black business, which makes your raw material for tire companies, the margins are expected to improve on account of the R&D spend that they're doing, and they're targeting a double-digit volume growth for the next 5 years. Saregama, the music business, wherein they're investing a lot in acquiring the content as well as doing some M&As and mergers and acquisition, and they're quite aggressive here in terms of M&A. 22 to 23% growth is what they're targeting in the flagship music licensing business, and the 32 to 33% margin. Spencer's, the retail arm, is targeting to become positive same-store sales growth in FY24 itself, substantially reducing losses in FY25 and increasing the share of the value-added products, which will be margin accretive. And lastly, RPSG Ventures, a large part of that business is the Tuyum brand. They are looking to scale that up in a very meaningful way, looking at breaking even in 3 years because they're looking to make the revenue 3x. So very important commentary coming in for this entire group, and we'll watch out for how the stocks react.
All right, thanks very much, Anisha, for giving us the latest note. Moving right on then, it's the diagnostic stocks. They're going to be in the spotlight. Nuvama has reported that Tata 1mg and Apollo 24/7 have raised the test prices in August. Let's get in Vamakshi, who joins in with those updates. Vamakshi?
Well, yes, a whole host of diagnostic as well as pharmacy stocks are in focus today, and that is because Tata 1mg has raised its test prices by around 12 to 37%, while Apollo 24/7 has raised the test prices by almost 60% in the month of August, and this is as compared to the prices that were seen in the month of June. The price hikes were mainly seen in semi as well as high specialized tests. In fact, the first price hike, the first aggressive price hike had come in during May to June of this year itself, and that was particularly from Pharm Easy. Online players are also seen gradually raising prices for selective preventive packages as well. For instance, Tata 1mg's Platinum Full Body Checkup and Pharm Easy's Basic Health Checkup have seen a price increase of almost 7% to 18% respectively, and this has happened between December of last year to August of this year. There are some smaller players as well, such as Netmeds and Healthians. However, they seem to be reversing the course. Netmeds has kept its test prices at a discount of almost 60 to 70% as compared with incumbents in Mumbai and Delhi. Healthians has also kept test prices at a discount of almost 50 to 70% to Metropolis's prices in Chennai. So all in all, what Nuvama has highlighted is that the pharmacy price wars are seen vanishing, but overall MedPlus discounts are looking quite attractive. So given those price increases, watch out for a whole host of diagnostic as well as pharmacy stocks, which includes the likes of Metropolis, Thyrocare, Dr. Lal Path Labs, Vijaya Diagnostic, Krishna Diagnostic, as well as MedPlus.
Right. Sandeep Sabharwal joins us. Let's connect with him to understand that what he makes of the market setup. Sandeep, it appeared like a proper scare on Tuesday. Thankfully, that has not translated into an ugly reality. Do you think the storm has come and gone?
Nikunj, it rarely happens that the markets just give a one-day correction and then things are hunky-dory, especially after the fact that when the mid-cap indices have rallied nearly 30-35% from the bottoms in almost a straight line. So I think wishing for a continuous accelerated rise in the markets is not something which would be in the interest of most of the investors, because I think then the fall will also be as drastic, because overall market valuations are no longer cheap as they were in March, April. And there is huge frenzy around small and mid caps. We look at what's happening in the IPO markets. The first 4-5 pages of all pink papers are full of just IPO ads. I think this reflects a build-up of extreme frenzy. I would be cautious on the overall markets for the next 2 months at least.
Right. So Sandeep, in the near term, what should one do then? Do nothing at all and just sit on what you hold? Or do you think ease out from the small and mid-cap exposure, book profits there, and maybe keep that powder dry, or deploy that into large caps, say banks, IT, and maybe pharma?
So in small and mid caps, the strategy cannot be a singular one. So if you have bought something where you don't know why you have bought it, just because of momentum, many of these loss-making companies which are moving up every day and with no fundamental basis, and if you have made good money out there, it's best to cash out. If you have some stocks where you think fundamentals are good, it's a good story for the next 2-3 years, you don't want to sell it for a 10-15% fall to buy it again. So I think it's not a singular strategy. It has to be a strategy based on what you hold. Secondly, what's the proportion of these small and mid caps in your overall portfolio? If it's very large, then it makes sense to cut back. And thirdly, what's your overall equity exposure? So if your equity exposure is very minute, then it doesn't matter to you. If it's very large, then it makes sense to have some cash at this stage.
All right, that's the view coming in on the markets, but time to put the spotlight on the editor's take. Today, we're talking about sugar in a very sweet spot, just taking a look at the kind of returns that we've witnessed in the last 1 month itself. It's been nothing short of great, because it's been double-digit gains and a lot of key positives, especially when it comes to global pricing, etc.
We've always looked at sugar that, what's happening to international prices, and then what would be the impact of weather patterns here. But this time around, for the sugar space globally and locally, I think the change here is that a lot of food is being diverted for fuel. I'll say it again. Food is getting diverted for fuel. Sugarcane is getting diverted for ethanol. And that, in a sense, is this massive diversion which is happening in sugar. If weather patterns are at play and the food diversion is happening for fuel, which only will increase, and more ethanol blending is going to be increasing. We're talking about 20% now. Then imagine that we are actually looking at sugarcane always been in scarcity. That's the fundamental way in which how things would move. And on top of that, this year in the near term, when I say next 2 or 3 quarters, you pretty much know that international sugar prices are firm. The challenge, Avan, is that for the sugar sector per se, every time sugar prices go up, will the government kick in? Will they do something? in terms of bringing the prices down. But the food secretary, I think yesterday, indicated that look, India is in a comfortable position right now and they do not see there is a reason to get panic, and they are very confident that the new crop which will come in and around Diwali is going to be sufficiently better. So the macro is food for fuel. Second, internationally, there has been a weather disruption which will keep the sugar prices up. Third, government action may not be there after the comments which have come from the food secretary. So all in all, if you blend all these three factors up, sugar could be in for a sweet spot. And right now, we've not reached at a level where I can say there's excess sugar, where it may hurt you and it could be a health hazard. So right now, it's that one spoon of chini in your coffee, which you really want to, one teaspoon in your cup of coffee, which you want to savor.
Okay.
I think they're there yet.
And that'll sweeten the deal. Okay, there you have it. So Aisha, we're talking about sugar being in an exceedingly sweet spot.
Yes, that it is. But Sandeep, we were discussing this last afternoon too, that, sugar hasn't participated quite much in the entire mid and small cap rally which has taken place. I mean, in comparison to what railway, defense and, the other spaces has done, sugar has done really nothing. For new investors, can they still buy into any of the sugar names now?
Among the larger companies, yes, especially the UP-based companies, because they are not going to see a production shortage. In fact, the recent interactions with Balrampur management has indicated to me that in their areas, the crop is pretty good and we could actually see an uptick in production for them, whereas the overall production goes down. I think the UP-based companies are placed well. Among the sugar companies, what we own in some of our portfolios are Balrampur and Triveni Engineering. So Balrampur is the safest bet, I think, because of their strong balance sheet and their overall market presence. And like you were rightly discussing, sugar has been one sector which has not participated so much in the rally. If you look at international sugar prices, yesterday they were trading rupee equivalent of 63 rupees a kg, whereas prices in India, I think for the sugar companies are 39 or 38, 39 still. This is with zero import duty. So even after all the concerns of government interventions, etc. So if those concerns were not there, these prices would have been much higher. I still think that this is one pocket where still we could have some overall return potential vis-a-vis the overall market.
Okay. Sandeep, this entire ethanol play, some are saying buy it on sugar because food for fuel will be there, sugar cane will be diverted irrespective of what the underlying weather patterns are. What is the best way to bet on this ethanol? Buy sugar, buy Praj, buy OMCs, buy blenders?
I think it has to be the manufacturers of the plants for these, so this entire aspect. So I think Praj Industries is in a sweet spot, and I think the company reinvented itself 2-3 times over the last few years. First with the 1G move, now with the sustainable aviation fuel, the compressed biogas story, as well as the Global Biofuel Alliance. The stock valuations remained lower than many of the other capital good companies because of concerns around what after the entire 20% blending cycle gets over. And now we see new segments of growth. The stock has rallied a lot in the short term, so I don't know what will happen over the next 5-10 days or a month. But I think over the next 2-3 years, the stock will still do very well.
Just wanted to get in, your take yet again, Sandeep, as to what the outlook is when it comes to, the positives within the entire banking space. The fact that we've seen, the fact that it's been strong growth, asset quality has been strong, HDFC, Kotak trading below their 5-year average. How are you looking at some of these large cap stocks now regaining momentum like we have seen in the case of an HDFC Bank, for instance?
Yeah, so among the entire large cap space, if you look at the market overall, it's the large size private sector banks which have been relatively subdued in the near term because they had a substantial rally earlier. And now they have gone through a phase of consolidation. So my preference in order would be ICICI Bank as a core holding, Axis Bank as something where we could see possible potential, still some re-rating, and then followed by something like HDFC Bank and IDFC, because it's run up so much, so that's why it falls below that. Kotak still has valuation concerns and management change uncertainty, so that's something we need to watch out for.
All right, in the meantime, there's also the latest note that's come out from Jefferies on the pharma sector, talking about how the core portfolio price erosion could remain benign in the medium term. They are also talking about how the import alert at plants of Sun and Intas may have played a key role in improved pricing, but by and large, they believe that the benign generic pricing, due to several factors, is hitting the industry simultaneously. Your thoughts, Sandeep, on the overall valuation picture and the news flow that we've seen within the entire pharmaceutical space?
So again, because the markets have run up so much, so we could see some comeback in the defensive sectors, and that could reflect in the performance of some of the companies which have been doing well, like Reddy, Sun Pharma, and the turnaround which we are seeing in Lupin. The news flow is disparate. Some analysts say that pricing pressure still exists. Some companies are indicating it's moderated. But I think overall it's moderated, and the input cost pressures have also moderated. So I think that's plus the fact that rupee is depreciated. So I think all of this, that is adding to the earnings growth outlook. So in the overall market context today, where markets have rallied to 20,000 plus, I would think that the potential for pharma as a sector to outperform is much greater now.
All right, stay on with us. Let's put the spotlight then on the steel sector that's seeing the impact of the rising raw material prices. But what is leading to this rise in prices in the first place, and what's the outlook on where demand's headed? Let's understand all of that a little bit better with Ashesha, who joins in. Ashesha?
Well, yes, steel stocks are in focus today, and that is because prices of both key raw materials, iron ore and coking coal, have been increasing over the last couple of weeks. In fact, coking coal prices have risen nearly 12% on a month-on-month basis, and now they stand at about $290 per ton. Remember, we rely on imports totally for coking coal, and coking coal is a major raw material. It contributes about 45% of the total raw material cost, and hence any surge in global coking coal prices is a negative for domestic steel mills. Iron ore prices, meanwhile, have also risen. In fact, Chinese mills have increased capacity utilization, and there is some disruption of iron ore inventory, which is leading to the surge in global iron ore prices. Australian fines rose by about 15% on a month-on-month basis, and NMDC too yesterday announced a price hike of about 300 rupees per ton. Now, if you look at the iron ore prices trend over the last few quarters, this quarter it has been on a lower side, but in the last few days we have seen a sudden surge in both iron ore as well as coking coal prices. Now, as far as domestic steel demand and steel price environment is concerned, that continues to remain solid. Imports from China are coming down, which is a positive for domestic steel demand. Domestic steel prices have also risen by about 11% on a month-on-month basis. So on the domestic front, everything looks good for the steel mills. As far as the current spread structure is concerned, contribution stands at about 38% of the HRC price globally. So current HRC prices stands about $550 per ton, and contribution stands at 38% of the global HRC price. Remember, when recently steel prices rose, all of these steel stocks had run up a whole lot, and now with the surge in raw material prices, let's see how these stocks react.
All right, thanks very much, Ashesha, for those details. Time for some top fundamental stock calls. Let's hear it out from Hemang Jani.
I think a very smart pullback by some of the pharma names, and prominent ones what we like at this point are Dr. Reddy's and Aurobindo Pharma. Aurobindo in particular is seeing a lot of traction, I think, in the last 3 months or so, both in terms of their operating performance and the stock price performance. Both it's done exceptionally well. Some of the mid-cap names like Laurus Lab, Granules, they continue to look okay, but one should really look at that as a tactical play, because the entire, the API segment that they are operating in, things are not that clear. But I think as a short term, maybe 3 to 6 months kind of a time frame, these two names are looking quite interesting.
The business is humongous. Mr. Vaidyanathan, according to me, is the best banker in India. And I see no let up in this stock. Yes, it's an expensive stock. It has run up far in excess. But who's to blame? There was so much of under ownership. And I think IDFC First is headed higher. As a disclosure for me, IDFC First Bank will be the next SDFC in the making in the next 5 years. So please stay put if you are invested. And if you are looking for corrections, then this would be good opportunity as it consolidates closer to 85-90. It was a lending institution which had benchmark loans at much higher rate of 9.5%, but almost 80% of that book he has redone, at much lower rates. So yes, there will be this cost of funding. But on the other hand, I think that the growth outlook and the NIMs which they have and the type of variable growth which they are looking at is very, very impressive.
Okay, let's continue our conversation with Sandeep Sabharwal. Sandeep, wanted your take regarding the QSR space. There's just the news flashing for you at the bottom of the screen where there's a large trade happening on Restaurant Brands Asia as well. But overall, with the World Cup lined up, with a lot of those festivities lined up, do you think it's the right time to buy or it's already past us?
So QSR space has a lot of players. So some of those companies like Westlife, etc., are trading at highs. Some of the others like Jubilant, Foodworks, etc., because of their subdued performance, they are more near 30-40% below. So I think it's not one size fit, but overall, I think there is some positivity because there's an expectation of ebbing of cost pressures and improvement in sales mix as we enter, like you said, the World Cup and then the festival season, etc. And that's what reflected in the performance of some of these companies. Among the QSR companies, we own Devyani as well as Westlife, and I think I would be still positively inclined on them.
Sandeep, in the last month or so, are there any fresh buys that you've made or recommended?
So fresh additions, we added some Praj initially before this run-up happened. Then we've been accumulating Voltas because I think that's one of the larger mid-caps which has not participated in the rally and where I think people are very much focused on the room AC front, whereas on the projects business, their order book has moved up substantially where the execution will come up. And after 3 seasons of poor AC sales, room AC sales, eventually it will also catch up. So I think that's a somewhat contrarian bet. Near-term earning picture is still unclear. But it's something what we have actually been accumulating.
Right. Okay, good to get in those strategies as well. In fact, Kunal, let's check in on the charts of both Praj as well as Voltas while we're at it.
So Praj was one of the first stocks from the sugar-related pack which had managed to break out. Balrampur Chini, I think, had just given a breakout yesterday. Dhampur Sugar, Andhra Sugar, etc. Most of the other stocks have given very recent breakouts, like maybe 1 week back or kind of a time frame on an approximate basis for most of the stocks. But Praj, on the other hand, I think the breakout was seen 1.5 or 2 months back when the stock had broken past about that 400, 450 mark, which had been a huge resistance for the stock price. And now Praj is actually completing a major flag pattern on the monthly and the quarterly charts. And that started off from the 2020 lows when the stock was 2-digit for itself. So it's a very strong breakout for Praj. And it indicates that from where it left off in 2021, and the stock is at 450 after a consolidation of 2 years. The stock is ready, already ready for a breakout on the upside and moving up higher. I would expect the stock to head towards at least 720 to 780 mark, possibly in the next 1 to 1.5 odd year. For Voltas also, this could be interesting because I think Voltas and if I can probably put Havells in the same space, both these stocks have been huge underperformers. Voltas had gone through a price correction, Havells had gone through a time correction. Now Voltas had come back above the 200 moving average just about I think 2 weeks or 3 weeks back, when the stock had broken past about 800 levels. So it's starting to show signs of recovery and volumes making a decent comeback. Golden crossover also happening for Voltas on the daily charts. All of that is attractive for the stock. I'm expecting this to be a trending stock going forward.
Okay, so that's the take coming in as far as some of the technical checks on Praj Industries as well as Voltas. But a lot of newsmakers today, and of course quite a few from the IT sector as well. TCS has seen an upgrade coming in from Avendus Spark, and then of course for Infosys there's that $1.5 billion MOU that they have signed with a global client, but it's for a period of around 15 years. Sandeep, right time to buy IT or wait for the earnings?
So I think IT is one sector where I have not been buying so much because of overall growth concerns, both domestic, globally mostly, because there's no clear picture on demand level at this stage. However, what happens is that when the market revives, then the large caps in every sector start participating, and that's something which we have seen in the IT sector also. So I am still not very convinced on the overall IT story at this stage.
Convinced on the IT space, but Nuresh, you are incrementally getting more convinced about the chart patterns there, right?
So one by one, we've seen in IT, it started off with niche, small cap and mid cap names going back and hitting new all-time highs, new 52-week highs. And now we are seeing the large caps turning around. So the largest of them, TCS, for example, is back to the prices where it was in March, where it made a top around 3,500, 3,600. Also in September 21, that is where it went up from 3,500 to 4,000. So TCS is shaping up after a breakout about 35, 3,600 towards that 4,000 mark eventually. HCL Tech is the one which is the most interesting because that stock has been a clear outperformer in the larger names. Broke out about 1,200, now at 1,280, not far away from an all-time high of 1,350. So that could be the next one. And the last one remains Wipro purely because of a 50 or more than a 40-50% fall from the top. So there is a lot of recovery possible here. So Wipro could go towards 480 to 500 in the short to medium term. So these three names look interesting in the large caps. The mid cap and the small cap IT, we are continuing to see slowly and steadily a pickup. We've seen a LTI tree slowly break out, but the momentum has not been great as it has been in some of the leaders. So overall, we are seeing a selective recovery on the IT pack as such.
The other point to really talk about and note is that Brent prices are back at the $94 per barrel mark. Now, prices, remember, have already escalated to a 10-month high. It's not like we've not seen these 94-odd levels previously in the past. We have. But it is the highest we've seen since November 2022. Remember, Saudi and Russia have extended the production cut, and that's clearly impacting these prices. The cut, of course, is going to get reviewed on a monthly basis. But yes, OMCs, they stand to take a hit on their GRMs. So that's going to get one space which is going to be impacted. The oil explorers, I mean, for them, this is net neutral, a move on crude. ONGC, Oil India, Vedanta, HOEC, they may not see much of an impact really. Higher crude, remember, means higher earnings also for them. For paints, of course, because 40% of their raw material cost is oil and its derivatives, it's going to be a challenge, and we've already seen Asian paints and the rest of the paint sector as well, how it's been a bit of a casualty of late. And that's that's pretty much the case for aviation too. So Interglobe Aviation is one such case in point, wherein the major raw material is ATF or fuel for them. Lubricant manufacturers, again, 50% of their RM cost comes from crude. And then for tires as well, about 40% of their raw material basket does constitute of crude. But Sandeep, purely basis the spike up that we've seen in Brent, would you recommend shorting any of these crude sensitives?
So I can't recommend shorting, but I think I would think that there would be real margin pressures come up for some of the sectors. For example, tires was going through a benign raw material price cycle, and now we've seen a 20% move in crude prices. We've seen a very swift 15% move in global rubber prices. So I think such rapid moves in input cost pressures, it's very tough for these companies to pass it to the consumers. So I think we'll see the impact. Similarly, for paints, etc., we will see the impact of these. And to that extent, and paints in any case, we are seeing increased competitive intensity due to the entry of Grasim. So I think we need to be cautious on these sectors for sure.
All right, Sandeep, good to have you on board. Thanks so much for joining in and sharing with us your outlook on the markets. What are the pre-open rates indicating this Friday morning? Well, one would have thought that with the kind of momentum we saw across the globe, it would be a solid start to the green, but just about a tentative move nonetheless, a pretty flat move on the frontline indices. What are the top mid-cap ideas from our chartists? Let's find out. Naresh?
So that would be a buy on CARE ratings with a stop loss at 830 and a target price of 950. The stock has slowly and steadily trended up. The last 3-year highs are closer to this 750 to 800 mark, which got crossed. And now it's been slowly trending up. Yesterday was a good price volume uptick, a fresh 52-week high here. So good relative strength in a market which has seen mid-caps correct. The stock has continued, did not correct as well 2 days back. So clearly strengths here could be headed much more higher in the medium term. So a buy at current level, stop loss at 830, target price of 950 plus.
All right, watch out for CARE ratings. Meantime, Kunal, what's on your radar?
So again, betting on PSU banking stock, Bank of India is something which I would recommend at current levels. Did quite exceptionally well yesterday. The stock was at 105, 107 levels in terms of closing. Great momentum and good volumes pick up for Bank of India. So would expect this follow through for PSU banking stocks as well as Bank of India at large. So would suggest a buy 114 as a target, stop us at 103.
Okay, it's a flat start. That is what the pre-open rates are indicating this morning. Couple of stocks which are going to be in focus. Bharat Forge, after they are going to be producing that armored vehicle for Paramount's clients. So look out for what that stock does. We were just talking about the crude spike up or Brent spike up to 94. ONGC, considering this price escalation, that stands to be a bit of a beneficiary. And then, of course, Infosys as well. They've bagged a 15-year order worth about $1.5 billion from one of the global companies. That also is going to be. Lots of other stocks, but let's tell you what's happening outside. Lots of other stocks, but let's tell you what's happening outside the world of equity markets. And in a stringent move, France has halted sale of iPhone 12 due to concerns over excessive electromagnetic radiation emissions. Now, the French regulatory authority also demanded that Apple address the issue with existing iPhones. Apple is contesting the decision, providing lab results to demonstrate compliance with global radiation regulations. The firm is expected to respond in about 2 weeks' time. And following the outbreak of Nipah virus in Kerala, the state government has created 9 containment zones to counter the spread. Additionally, the ICMR has delivered the only antibody vaccine available to treat the virus. Neighbouring Karnataka and Tamil Nadu have also been issued health advisories, heightened surveillance, and advise people against unnecessary travel to Kerala. And Mumbai's iconic red double-decker buses are set to go off the streets after being around for a good 15 years. Additionally, the open-decker buses, which have served as sightseeing buses since 1990s, will also be taken out of service come the 5th of October.
Okay, let's talk about the world of sports as well. And the Asia Cup finalists are decided. India will face Sri Lanka after they beat Pakistan in a rain-marred last-over thriller. The final between India and Sri Lanka is scheduled on September 17th at 3 p.m. Meantime, in the world of sports, Taylor Swift dominates at the 2023 MTV Video Music Awards as she wins 9 awards, including Video of the Year for Midnight's album, track Anti-Hero. Swift won in every televised category she was nominated for.
All right, let's get a move on then. What's the khabar on the street? Well, today it's Time Technoplast that's in the spotlight. Now, according to sources, the company is in talks with investors to sell part of their overseas business. What else is cooking and brewing? Let's take it across to Ashesha, who joins in with those details. Ashesha, fill us in.
Well, yes, so the board of Time Technoplast had approved consolidation and restructuring in April last year, and now what we are getting to learn from our sources is that it is looking to sell a part of its overseas business. In fact, we also get to understand that it is already in talks with investors and that the announcement is expected to come in anytime soon. Company has a total market cap of about 3,500 crores and the overseas business is valued at about 1,000 crores. Overseas business contributes about 37% of its total revenue, and the proceeds that it will receive from the sale of part of its overseas business will be used for debt repayment and for the capex plans of the company. Remember, company is benefiting from China Plus One strategy, and it also has manufacturing presence in nearly 10 countries for industrial packaging. We did try to contact the company, but we did not get any response from the company. But yes, as of now, we are getting to understand that it is looking to sell a part of its overseas business, and that this selling will be done in parts. So on account of this news that has come in, the stock will be in focus today.
Right. Okay, let's move on and let's talk about all the other stocks as well, which are going to be in focus. And clearly sugar, after the kind of spot that we've seen in the entire sector, and of course allied stories like Praj as of yesterday, it's seen very impressive returns as well this month, and there are a lot of positives which are now building in. In fact, let's hear Nikunj's take on the same.
You know, we've always looked at sugar that, oh, what's happening to international prices and then what would be the impact of weather patterns here. But this time around for the sugar space globally and locally, I think the change here is that a lot of food is being diverted for fuel. I'll say it again. Food is getting diverted for fuel. Sugarcane is getting diverted for ethanol. And that in a sense is this massive, massive diversion which is happening in sugar. You know, if weather patterns are at play and the food diversion the food diversion is happening for fuel, which only will increase, and more ethanol, blending is going to be increasing. We're talking about 20% now. Then imagine that we are actually looking at sugarcane always being in scarcity. That's the fundamental way in which how things would move. And on top of that, this year in the near term, when I say next 2 or 3 quarters, you pretty much know that international sugar prices are firm. The challenge, Avan, is that for the sugar sector per se, every time sugar prices go up, will the government kick in? Will they do something in terms of bringing the prices down? But the food secretary, I think yesterday, indicated that, look, India is in a comfortable position right now and they do not see there is a reason to get panic. And they are very confident that the new crop which will come in and around Diwali is going to be sufficiently better. So the macro is food for fuel. Second, internationally, there has been a weather disruption which will keep the sugar prices up. Third, government action may not be there after the comments which have come from the food secretary. So all in all, if you blend all these 3 factors up, sugar could be in for a sweet spot. And right now, we've not reached at a level where I can say there's excess sugar, where it may hurt you and it could be a health hazard. So right now, it's that 1 spoon of chini in your coffee, which you really want to, 1 teaspoon in your cup of coffee, which you want to savor. Okay. I think they're there.
Okay, since we are talking about food being the new fuel and the way inflation has been moving with a bit of a scarcity coming in for a lot of these soft commodities, ET now also caught up with the food secretary to get a sense as to how situation is on the ground. Listen in to the conversation my colleague had with Sanjeev Chopra, the food secretary.
Availability of sugar in the country is about 85 lakh tons as of now, which is sufficient for 3.5 months of requirement, of the consumption requirement of the country. We are not foreseeing any kind of upswing in the prices in the upcoming festive season. And there is some kind of a rumor being created about the shortages in the country. So I think, as I've clarified, the stocks that we have now are sufficient for 3.5 months.
The big decision that you have taken regarding that, you have brought down the stock limit of the wheat. What is the exact number and why this decision has been taken, sir?
So stock limits of wheat has been brought down from 3,000 tons to 2,000 tons for the wholesalers and traders, and also for the big chain retailers. So this is on account of the fact that the 3,000 ton which we had given in June was for the next 9 months requirement. The next harvest will come in April. So for the 9 months, 3,000 tons had been given to these entities. Now that 3 months have elapsed, and 6 months are left. We've reduced it by 1/3. So from 3,000, it's been brought down to 2,000.
One final comment, there has been constant, that you term as rumor, that the harvest is going to be severely impacted because of a deficient monsoon. What sort of feedback that you are getting, what sort of analysis you have, and what is the larger message that you want to share?
So this is for sugar or wheat?
For both, sir. Because regarding sugar, it has been said that the crop might take a hit.
So sugar, as I said, that the rains were deficient in August. However, the heartening feature is that since beginning of this month, the rains have been good, as a result of which the crops have revived, particularly in Maharashtra and Karnataka.
The stock availability of the edible oil, comfortable position?
Again, stocks are much more than what we had last year compared to last year when we had about 23 lakh tons of stock at this time. It's about 37.3 lakh tons this year.
All right, let's get a move on then and find out what the top index calls are from our chartists. What is it that they're advising? Well, stay put basically seems to be the call. A consensus call there, hold and no trade from our technical guests. That's the market moodometer on the Nifty index. It's been certainly quite a memorable week after scaling new highs. A bit of consolidation, 20K is what we're seeing on the index. For the Nifty Bank Index, a buy from Kunal basis some of the open interest data that he was highlighting, hold from the rest of our technical chartists.
Okay, counting down to the market open then this Friday, and what a week this has turned out to be, right? First, those fresh record highs, 20K on Monday, the correction that, or dip actually, not correction, which played out on Tuesday, and then the consolidation that we've seen all through Wednesday and Thursday, slowly inching up higher. Kunal, how's the grand week finale going to be today?
Well, I think it should be on the higher side, and I would probably expect that we can maybe end up with the Bank Nifty making a new high for itself, given the kind of data, the banking internals we've seen. Classic mix of private sector banks making a comeback and the PSU banking stocks going into a high beta mode or a breakout mode for themselves. I think the only underperforming stock from the private sector banking name so far, I think, is Kotak Bank, which has not risen up quite well as compared to the other stocks. But most of the other names like Axis, IndusInd, ICICI, even HDFC Bank has managed to pick up a good 5% odd from its previous swing lows. So I think the mixture is quite apt for the Bank Nifty to make a fresh new high.
Okay, Naresh, are your bets as well along similar lines that it's Nifty Bank now, which should conclude the week with an all-time high?
Very similar, yes. The banks have not been catching up, and even on a, say, post-COVID basis, the relative underperformance is still there. So out here, say, the viewers, banks need a catch-up. It's only because of the heavyweights like HDFC Bank, which is almost the largest weight or closer to 25-28% of the Bank Nifty. That has taken the Nifty bank not to a new high, but rest of the banks have started making new all-time highs. So positive on the Bank Nifty, expecting a dash towards that 46,300 and then 47,000 also.
On the Bank Nifty, that's the word coming in. Just wanted to highlight the stocks which are buzzing around in the pre-open, and there's just 47 seconds left for that. It's of course Restaurant Brands Asia, which is in focus on account of that large deal that happened. That stock is likely to open with a gap up of almost 11%. Triveni Turbine is the other one. CDSL is likely to open well in the green. Hindalco is expected to continue the momentum on the upside as well. The overall cues as well have been quite okay, Aisha, for the start of the trading session. And if you look at the pre-open rates, they are suggesting we are going to start around that 20,150 mark on Nifty.
Yeah, seems like we're headed in for a positive start. Anisha was just flagging off some of the stocks which are going to be in focus, and Naresh was betting big on banks led by HDFC Bank. And remember, HDFC Bank has that FTSE rebalancing as well, on account of which you will see some amount of inflows get into HDFC Bank. And in any case, within the banking pack, this has been the leader of sorts. The first rates then on your screens this Friday morning start off in the positive. Both the Nifty as well as the Sensex are chugging along nicely. 20,150 a print for the Nifty 50 in the spot. And I think we should already be around that 20,200 level for the Nifty futures. Metals, once again, I can see are on a tear still. So Tata Steel, Hindalco, both those stocks have made a very smart move. Hindalco is holding up 2% right now. Tata Steel is up nearly about 1% or so. There's ONGC, Bajaj Auto, all those stocks are looking extremely positive as we speak. Let's check in on what Strides Pharma is up to. Remember, it's received the tentative US FDA okay for one of their tablets. So that's one stock which is going to be in focus. There's, of course, CG Power as well, wherein DAM Capital has now initiated a buy with the target price of 500 rupees per share. That stock starts off in the positive, about 2% or so. TCS, Anisha had earlier flagged off this stock. Spark has upgraded it to an add from the earlier reduce. And they've also upped the target price in this one to 37.60 from the current 3200, 35.72 on TCS as we speak right now. While we're at it, let's check in on Wipro. Starts off in the positive. Infosys as well will just come for you on your screens. And LTIM, which has been quite the mover all through this week, that will be up on your screens next. Alchem Labs, some negative news flow there. Income Tax Department is conducting a survey at some of the company's offices and subsidiaries. That stock is down about 1%, not really facing the heat as we speak right now. A bunch of other stocks which we would want to flag off, and let's see the big movers from yesterday, considering it was all about sugar. So Balrampur, Praj, Dwarkesh Sugar, the entire pack should just come off you on your screens. Triveni Engineering as well. Balrampur is still holding strong, 441 on that stock price as we speak. Balkrishna Industries, Granules, NMDC, these were the big movers yesterday. Sugar, of course, continues to be the strong pocket, but Granules, Balkrishna, NMDC, they are also seeing a continual up move in trade as we speak right now. Aman, any other stocks you're spotting?
Well, it continues to be the broader markets that are looking a little bit more buoyant as compared to the frontliners. So yes, some of those names within that space. And that includes movers in trade today like Bajaj Electricals, Karur Vyasa, Ajanta Pharma, something like a Nalco, even Lemon Tree Hotels, by the way, is up about 2% plus, but the gains are limited to about 1.5% to 4.9% at max. So let's find out what our chartists make of the texture of the market this morning. Bread skewed in favor of the gaining side, 20,100 on the screen. Kunal, your first take and your first trade.
Well, that will be on the Bank Nifty. So again, the opening for the indices are quite, as per the expected expectations. I think Bank Nifty is something which I'll be, keenly interested in terms of trading, because my sense is that the index should be heading towards a breakout, which is another 250-300 points at least from current opening of 100 plus points for the Bank Nifty.
Okay, point taken, but do remember it's the record high that the market has hit yet again. The big question, of course, is where do we go from here on? Because the Nifty, the earlier high was 20,110 or 20 thereabouts. So from there, we have opened at record levels for Nifty as well as Sensex. But the question, of course, is where do we go from here on? Naresh?
So the view remains the drift is on the upside, 20,500 and 47,000 eventually is possible. The stock which I would like to go for is Granules India, which has seen a good breakout, could see follow-up over the next few sessions.
Okay, there you have it. Those are what our chartists are betting on this morning.